Hello, my name is Kieran. I'm the Head of Aviation Advisory for KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Firoz Tarapore. Firoz is the CEO of DAE Capital. We're recording this in relation to our Leaders Report for 2025, and I should say that it is early November 24 and we're in Singapore. Firoz, thank you. Pleasure as always to have you with us. And maybe while you need no introduction, you might maybe give a little bit of background on DAE Capital.
Sure, happy to do that. So happy to do this again. DAE today is two things. One, we're a top 10 lessor where we have approximately 500 aircraft that we either own outright or manage on behalf of our financial investors, and that's valued at about 18 billion. And then we also have a MRO business, an engineering business, where we are the largest provider in the region of MRO services, and we're looking to grow both of them at pretty aggressive rates in the near future.
Great, thank you. And thinking about, I suppose, the environment, DAE obviously a hugely successful business, and I think customers in something like 60 countries, so you've probably unique position on kind of the geographical market. How do you think demand is playing out across geographies in different regions?
So we are, as we all know, in a unique environment where a lot of factors have affected the number of planes that are being available. And customer demand still remains extremely robust. Pricing remains pretty firm, maybe some pockets of kind of marginal friction. But in the backdrop of that, I think we have demand from virtually every part of the world because people need aircraft to be able to fly the customers in their particular region. When we look at the environment, it's hard to, at least in the very near term, see that the blockages that have created this situation will change. Over time, they have to change, but I think when we look at where we are at the moment, we think that demand is likely to stay robust, pricing is likely to stay robust, and as a result of that, we think that both release rates and residual values will hold up really well as we look at the next 12, 18-ish months.
And that's obviously clearly on the demand side. Clearly we have lots of challenges on the supply side with the OEMs, both aircraft and engines. I suppose, is this having much of an impact on your business or the industry in general at the moment? And how do you see that evolving in the medium term?
So, that's a very good question, because I think one of the things that in 2024, 4 years on from the pandemic, we would have thought would be a thing that we wouldn't be talking about. The irony is that regardless of the issues that one OEM is going through, which are driven by regulatory concerns, strikes, etc., everybody seems to be having these issues that otherwise we would have said would be resolved by now. So I think long term, it's not healthy that the replacement cycle, which was so properly advanced, has been delayed in the way that it has been delayed, because ultimately we're all better off by having the fuel efficient aircraft that we all thought we would have by now. And yes, the supply demand situation might be a little bit different, but I think overall getting those solved and getting production back up to pre-pandemic and even a little bit higher levels, for me at least, would be the better answer, because then we would have a proper replacement cycle, a fleet that is modern, more fuel efficient, et cetera, et cetera. As we look at all the challenges that the OEMs are going through, will that happen in the near term? I'm not sure there is a clear yes to that answer.
Yeah, and I think you mentioned actually, just thinking back to lease rates, lease rates are strong, and clearly you have, I think, circa 120 customers globally, right? So massive customer base. So not just in terms of lease rates, but how are you seeing them in terms of building on that supply issue, thinking about lease extensions? Has that changed any in the last 18 months?
Yes. So I think everybody wants to first make sure that they have the aircraft that they need to meet the customer demand that they have. And when they see that they're not going to get the new aircraft that they've ordered, one of the first things that almost every airline has done is to act to ensure that the lease maturities that they have coming up are not in fact being taken away from them, but kept in the. So we have seen extensions all the way from short term to I would say quite healthy 6+ year extensions, because I think those are the airlines who've taken a more pragmatic view to say, we don't know what solutions will exist in 2 years' time, but if we secure it, okay, we'll have maybe more aircraft, we might be able to test capacity, test different routes, etc. And those people are actually holding on to the aircraft for way longer than otherwise they need, because it's a very good insurance policy to buy at today's rates, if you will. This is smart, because otherwise you will have a situation where airlines won't have enough aircraft in their portfolio. We'll see.
Yeah, and do you feel that there's a risk of that not all airlines are probably thinking forward enough in terms of that and the supply issues?
There is always that, and I think that in the grand scheme of things, there are airlines today who wish they would have not given up the aircraft or found out a way to secure additional aircraft. But I think this is just the give and take of life. Kind of some of them will make the right decisions, some of them will. I think one of the secondary consequences of this decision is that our weighted average age on the aircraft that we own is actually going up, because aircraft that we thought we'd have back by now and either traded away, we've not been able to do so. So we're holding on to aircraft longer than otherwise we would. But I think people understand that we're getting paid in this environment to do so, that weighted average age, which is higher than what we want. But I think the lease rates are commensurate to take on that portfolio age.
And again, I suppose building on the supply issue, certainly when we've spoke over the last couple of years, the secondary trading market maybe would have been a little bit sluggish, and maybe it still is. But I know obviously DAE have done 2 kind of large portfolio acquisitions this year. One of them for an average age of 3.4, so quite young. And in terms of that, are you seeing more activity in that space, or how is that playing out?
Ironically, the trading market is just about as active as we've seen it in recent years. So, for example, you referenced transactions that we announced. So we announced transactions totaling 33 aircraft. But to get to those 33 aircraft, we've evaluated this year nearly 500 aircraft. Some of them, obviously, right off the bat, don't meet our criteria. Some of them require a lot of work. But our underwriting criteria are such that we're hitting on about, I would say, just under 10% of what we're seeing, because in addition to what we've announced, there's a few in the pipeline that I think are kind of quite healthy candidates for getting to the next stage of transaction announcement, etc. The interesting element is that as much as we're finding things attractive to buy, we're also finding that it's a very attractive market in which we can sell assets, and assets of all stripes, whether it's older assets or assets with engine types that are not the preferred engine types, because the requirement either for feeder stock for freighters or just for passenger is so robust that people are buying, leasing, extending, and I think that's a very good thing for our industry to have.
Yeah, volume and transactions is helpful for everybody. And maybe moving off that for a little bit, obviously when we spoke last year, we had I suppose a growing interest rate, if that makes sense. Now it's clearly slowed a little bit. Do you think it's more settled? Do you think that's having an impact? You've had 2 kind of announced this year, 2 very significant 5-year unsecured term loans. How do you feel that'll play out in the next little while?
So I think it is a good thing that central bankers around the world have found what is otherwise conveniently referred to as soft landing. So a scenario where they've tamed inflation without destroying growth. It's a good, very good outcome from our perspective. What we see in the future, or in the near future, is that despite inflation having come down by very decent numbers, there's a lot of sticky elements to inflation, and we think that some elements, such as, for example, the labor agreements that are being put in place now, and one that hopefully will be announced today, are resulting in quite significant kind of so the stickiness of inflation worries us a little bit, that the pace of interest rate cuts may not be as planned. I think the data on job growth, underlying economic activity, has been relatively robust, with one or two crazy numbers kind of coming out. But I think with the dual objectives, we hope that the stickiness that we see to inflation is a little bit lower, which will allow the Fed to, or the other central bankers, to kind of move in a much more predictable fashion. For us, it doesn't make that much of a difference, because at the end of the day, we price to a particular return given the rate environment. So from a customer standpoint, I think it'll be very good, because any reduction in rate we can pass along as a lower lease rate to our customers without impacting the margin that we make on that. So I think from that standpoint, because the customer is looking at a fixed expense, I think it would be better if we had an interest rate environment supported by fundamentals that would be a lower rate environment than we're seeing today. I mean, nobody needs 0% interest rates, to be honest, but nobody needs some of these recent levels either.
And staying on the kind of the financing piece, I suppose, what's your assessment of the current position of the aviation debt market? And as mentioned, you've tapped the unsecured, and are there other areas you might look at going forward?
Yeah, so in the last 18 months or so, we've found this unique phenomenon where we are getting offered rates away from the capital markets that are substantially better than what the capital markets are affording. Yeah. And when I say capital markets, I'm referring to either the conventional markets or the sukuk markets, which is kind of our backyard, if you will, because liquidity in the banking system is quite significant, but more importantly, liquidity in the banking system in our region is even more significant than that on a relative basis. So we're seeing the benefits of that. We're seeing the benefits of being owned by a state, for the lack of a better word, and that coming straight through to us. So unlike other lessors, which might be compared to lessor spreads, we get compared in a different way to kind of the relative risk in the region. So when we put all that together, we're finding that the banking market in the region has been significantly more competitive than the capital markets have been. And that's one of the reasons why we haven't been to the capital markets. Now, having said that, we need to fix it. We need to get back in, because at some point it's not about the cost. But that cost is also quite significant for us to kind of look the other way. Liquidity in all markets, I think as far as we can see, continues to be quite robust, and we'd be able to do something in any of the markets that we play in.
And you mentioned capital markets, and we've seen, I suppose, a modest increase in ABS activity in the last couple of months. Would you ever consider going down that route?
Yeah, so for us, up until the pandemic, we were regular issuers in the ABS market, but with the e-notes sold to investors. Yeah. If we don't sell the e-notes, for us it just becomes secured funding. And at secured funding value propositions, it's not an attractive proposition, because we can raise money at significantly better margins and with considerably more leverage in the system, if you will. So I think we are very keen to see the e-note market kind of come back. And when that does, we would be very keen to issue. I think anecdotally we'd say that the buyers, the structured credit buyers of e-notes, are generally amongst the smartest kind of financial investors. And it is a surprise to us that that smart investor set hasn't picked up on the incredible valuation that they've missed out on over the last year or two by not stepping back into the market. I think the volatility spooked them, but unfortunately, instead of kind of standing their ground, inside the eye, they kind of say, no, we'll come back at some other day. And I think they've missed quite a bit. But now it should at least demonstrate that there is significant value if there's correct portfolio diversification and you have the right asset manager. I think it makes a difference. It makes a huge difference. And we've been able to do really well for each of our e-note holders, even through the pandemic. So we think that record will differentiate us, and we hope that structured credit buyers take a different point of view and come back kind of sooner rather than later.
And you mentioned, that type of e-note investor. Are you seeing, I suppose, any change in the type of investors looking at the asset class in the last while?
I'm not sure that there's a discernible change. For example, people who used to buy the risk represented by A notes, I think by and large the same, and so on and so forth. But the C buyers are not there. Yeah. The E note buyers are not there. Composition, I think, is by and large the same.
Yeah. And just maybe touching back to interest rates, you mentioned ultimately how interest rates shouldn't necessarily impact your customers. It allows you to maintain your margin and them to get a lower cost. But has it changed any return expectations outside of that? If you're trying to do a portfolio, even a purchase or a sale, has that interest rate change impacted the expectations?
Our targets for returns change every year, or even times within a year. Yeah. We will moderate those to reflect more so the conditions that we are looking at as opposed to kind of external events. So not that rates would drive such a thing, but for example, if we are full up in one geography or asset type, or if there's an age exposure that we want or do not want, we will put our finger on the scale a little bit by adjusting the targets at which we will underwrite. And I think by and large, the environment in which we underwrite also impacts. So yes, our targets keep on changing, appropriately so, because of how we want to influence our ultimate book. But I would say very much not driven by external environments like rate movements. And
maybe thinking a little bit about, you've obviously been very successful with a significant M&A in the recent past. And do you expect maybe to see more M&A over the next 12 months? And obviously we've seen the M&A market, it's largely large players getting larger. Do you think that has increased the importance of scale in the sector?
Yeah, so if you look back 20 years, the scale of the number one player is probably like a number 8, number 10 right now. Yeah. The 10th player, the 10th largest player 20 years ago, you won't be able to find. It's so far down there in the scale. So every year, scale gets redefined to the upside. Having said that, we would say that scale is still relative. At some point, there are diseconomies of scale, as we're discovering. But there is still scope, maybe other than 1 or 2 players, for the large to get larger. Unfortunately, there is no line of sight to a clear path to kind of doing that. When we acquired AWAS, for example, 7 years ago, AWAS was a company that was 2.5 times the size of our company at that time. And if we said, let's do that again today, there is no such prospect out there. There is no company that's more than 2x our size and is also available for sale. Because everything that's larger than us when we look up is in very solid hands, strategic hands that have said that they want to grow the business. When we look down to between us and number 20, I think by and large that same comment applies, maybe with 1 or 2 exceptions. So I think large M&A it's getting harder and harder to do, and that's why I think for us singles and doubles are more the name of the game. The home runs are just very hard to come by, and if a property like that came on, we think the competitive tension would take the pricing to a level where I don't know, singles and doubles may be the right way to get to a winning outcome.
Yeah, very good. And maybe I suppose, and look, we'll finish with the kind of the standard concept. So look, looking out over the next 12 months, what's your sense of the market and the sector?
I think looking out over the 12 months, we see some of the same structural conditions that we see today kind of existing, persisting, maybe a little bit less intense, but still out there. Within that, we see enormous prospects for growth through the channels that we've leaned into. So I think, the OEM channel continues to be challenged. Depending upon the outcome of the strike, we think today might be the day where the union will say yes, and then 2 months on or less than 3 months on, Boeing should be able to resume. And we hope that they get their act together in a way that the regulatory caps are also removed in short order, but no one knows what short order means these days, and that we see production kind of coming up. That's still a ways away, but in the meantime, we think that the markets, the trading markets, the other markets are really quite robust, supported by liquidity. So we see growing our business next year, maybe more so than we'll be able to grow it in the recent past. This year has been very good, but we think that next year will be even better.
Very good. Thank you. I guess on behalf of KPMG and Aerial Economics, thank you as always for your fantastic insight and for sharing your views. Thank you.
Thank you.